हाँ बोलो सर। नहीं, मैंने स्टार्ट ही नहीं किया अब तक। Good morning, folks. Can you hear me? And can you see me? There was some technical glitch with my PPT. Therefore, I had to stop my screen and I had to share it from another link. So can you guys hear me and see me now? So we can start with the people. Super. And can you see my slides moving as well? Can you see the Nifty 50 chart now? Because last time I think there was a lot of issues and I did not realize that there was some issue with my slides or some software glitch. Super guys, super, lovely. Thanks. So let's start. So good morning, everyone. Thanks for attending this PBL with Mayuresh Joshi, William O'Neill, India. Clear disclaimer before we begin, as always, anything that we discuss is not a buy or sell recommendation. It should be only construed to be educational in purpose and should be taken in that sense itself. Now the placement on how Nifty is at this point of time. FI selling has started coming back in a ferocious way. 6,000 crores odd is what they sold yesterday. We did witness a distribution day on the Nifty. The distribution day count. Mr. Mendoka, I'm speaking very loudly. If you can put your earplugs on. I'm as close to the laptop and speaking as loudly as possible. So if you can put your either your headphones on or your plugs on. So we did witness a distribution day yesterday. Luckily for the Nifty, we are very close to support. So let's see whether we can abide by these supports like we've done in the past. But what we have seen generally is that on the Sensex, there are 5 distribution days which have occurred, including the one yesterday. And on the Sensex, there has been a breach of the 200-day moving average. So one needs to be a little bit cautious because of all the macro risks that the globe is facing at this point of time. Inflationary concerns are genuine, and that's what the Nifty is indicating, right? If you see the last few days, the selling pressure has intensified. And it's not just India, folks. What you've seen is across the Asian Pac, a lot of emerging markets have come under pressure. So as per the O'Neill methodology, uptrend under pressure, Korea, China, Japan, Taiwan is definitely witnessing a lot of issues. when it comes to how the markets are placed. So being very, very cautious, being very, very selective at this point of time, and seeing and witnessing how these D-Day count actually transpires, not just on the index level, as we've always mentioned, but also how sectors are probably moving around is something that needs to be seen. Mr. Mazumdar and Rahul, I think please have a look through again, because I just asked and a lot of participants said that they can hear and see me properly. So either use your headphones or your plugs, if you don't mind, guys. As we move ahead, the major news that has happened, IT sector has come under tremendous amount of pressure. What we saw over the weekend in terms of Infosys's numbers, the kind of attrition that this sector is witnessing. Infosys at 27 odd percent. Mindtree, better than expected results. Constant currency growth was very reasonable. The kind of profitability that they posted was better than what the street expected. The order book at 1.6 billion, I've not mentioned that here, is very, very strong. Cash flow for the quarter stayed at around 500 crores. Cash on books is at 3,000 crores. So there is no issue in terms of cash flows for the sector as a whole. There is no issues in terms of the kind of client addition that these guys are doing as well. Attrition and margins remain a big sore point for the sector as a whole. For the sector, I think it is trending downwards below its moving averages. For the sector, I think the kind of exponential moves that they've given, any disappointment in earnings expectations can have a huge sell-off like we've seen in the case of Infosys and any other IT company that probably posts below par numbers. And last but not the least, the expectations that margins might come under pressure as unlock activities start happening. They were largely working from home, and the attrition issues. Like I mentioned, Infosys 27%, Mindtree is no less. It's almost 23 odd percent in terms of attrition rate. So I think IT is definitely coming under a lot of pump at this point of time when it comes to selling. Selling from the FIs continues over the last few days. Yesterday's figure around 6,300 odd crores, and you see what happened with the Nifty as well. On the derivative side, Harsh was asking me certain questions on the PCR front. It's being very low, but it's very volatile as well, Harsh. So I think I'll mail across derivative stats to you, or I'll ask the swing trading team or the TraderSmith team. We normally come out with a weekly derivatives report tomorrow, but I'll ask him the derivative setup in terms of how the setup is in terms of the call put built up at the index level. So that will bring clarity. Just wait for some time. The mail will come across. Crude has bounced back. What we saw as a respite last couple of weeks at around $100 odd has suddenly started moving higher again. And look at the US 10-year, which is a clear indication in terms of the risk factors, specifically the inflationary factors that all emerging developed economies are probably looking at. Along with crude, natural gas prices increase significantly higher, and therefore the kind of pressure points that are still built in because of these commodities not cooling off and second effects on the inflation getting played out. Supply chain issues because half of China is under lockdown at this point of time. Cases are exponentially moving higher. Even if mild, I think that lockdown creates further supply pressures and it accentuates the entire pain from a global economic standpoint when it comes to commodity prices, when it comes to second round effects of inflation, because logistic fuel costs start moving higher. And we've started feeling the pinch, right, guys? On our everyday use as well, you're probably seeing prices go higher and higher. We are hearing FMCG companies actually reduce grammage. So what will basically happen is the price will remain same, but the quantity might reduce in the packs that we are probably consuming. And therefore, everyday usage items are going up. And therefore, the kind of wallet share or the discretionary part that we save remain very, very low. And if this continues, I think it might have a profound effect in terms of GDP growth globally. And as RBI has also slashed down our estimates for GDP this financial year, that might be a reality for a lot of global economies, and therefore earnings might get impacted. And therefore, the up and under pressure that I was mentioning initially can actually become a prolonged effect. And therefore, being very selective in the market is the mantra that we need to follow. A few key results today: ACC, Mastec, LTI. LTI also announced the merger details with Mindtree. One really needs to see how the swap ratios are and in whose favor it might be. My own sense is that it could favor LTI, but let the entire nuances probably come out on this aspect. On the global scene, how the markets fared yesterday. US markets very flat. They were very volatile during the entire session yesterday. They dipped down, they gapped. I mean, they came back very strongly before the close. They came down and it again gapped up at the close of the day. Asian markets, looking at the US scene at this point of time, are either flat or up positively, and therefore I think markets in today's trading session might be a flat to positive cue that we are getting from our Asian counterparts. The header is wrong. SGX Nifty indicates a flat opening at this point of time, and whether that persists is something that we'll have to see during the day. Because if there is selling pressure that probably comes through, the biggest support that Nifty has probably got is around 17,000. And Harsh, as I said, send across all those details. 17,000 is where I think logically on the put call front should act as a support for the market. But let's see during the day how the entire scenario plays out. At this point, a flat to positive opening is what SGX Nifty is indicating. Now let's come to the charts of the day. Hotel stocks have held up largely. If you probably look at our suggested portfolios, our portfolios largely held out touchwood to be tad better on what the overall index or the overall mid cap or the broader universe is doing. And therefore, inflationary proof sectors where in earnings hit will be relatively lesser compared to other commodity plays where input cost inflation might be significantly higher and can get a dent in earnings is something that we are expected to probably witness. Now, hospitals as a sector push also happens to be a sector where inflationary risks are not that profound. Why? Because they've already done huge amount of capex. It largely depends in terms of how the inflow of patients is. So during COVID, I think the surgeries or opt-out of surgeries was happening. What we've seen from channel checks and hearing from management transcripts, that a lot of these opt-out surgeries have actually started coming in. And that is the most revenue accretive business for any hospital chain. Along with that, medical tourism, where a lot of foreign patients probably come in as inbound patients for these hospital and healthcare majors, act as a big booster. With visa regulations coming off, with international travel starting, medical tourism will pick up speed, and therefore hospitals are a large and a better bet against inflation to a certain extent because they probably do not get hit to a large extent, and hospital needs largely are met in terms of requirements that we all need to go through if the need for the same is mandated. Pharmacy, which is part of the hospital part as well, is also expected to do well as all these surgeries and post-medical care starts taking place. Now for Fortis in particular, I think from a canceling perspective, the number of funds have come down a tad bit, but if you probably look at the shares held by funds have gone higher. The N factor comes in play for all the factors that I've mentioned here. ROEs obviously were affected because of COVID, but if all these factors start moving in their favor, the ROE can show significant amount of improvement. What you're also seeing in terms of the formation itself, it's forming a nice cup with handle with 7% to the pivot for Fortis. So to a large extent, cases are starting to move up in India as well. But a few sectors like healthcare are something which will have lesser earnings impact. Hotel stocks will have lesser earnings impact. IT is classically supposed to be an inflationary hedge. But what we've seen and for the factors that I mentioned might come under pressure. If the markets come, as I've always mentioned, under significant amount of pressure over the next few weeks, if the distribution day counts go significantly higher, we breach moving averages. At that point, I think there will be some sanity where there might be some buying, where some bases are getting created for IT and pharma stocks. But most IT stocks, as we've observed on the sectoral front, below averages. And a lot of these stocks were either in stage 4, stage 5, which as per O'Neill we say should be avoided because late stage bases are prone to significant selling pressure for any or all the factors that I probably mentioned. So I think these are the sectors that we should probably focus in a high inflation environment. Hospital stocks, hotel stocks, because again, they're largely not that concerned with inflationary risks. And if it corrects too large, I think a certain section of IT, if certain bases are correctly formed at lower levels, and pharma probably comes to the rescue. So with this, I think Thanks for attending this pretty well. It's going to be volatile, but I think let's be on our toes and be very, very selective. So thanks guys for attending. Have a great day.